Let's be real for a second. Trading without solid data is just, well, it's a guess, right? You've got an idea, a cool indicator, maybe a gut feeling, but do you actually know if it has an edge over time? Today, we're going to fix that. We are going to dive deep into how you can use TradingView to put your strategies to the test, all before you risk even a single dollar of your hard-earned cash. So, here's our game plan for this explainer. First, we'll cover what backtesting even is and why it's so important. Then, we'll jump into the nitty-gritty, a step-by-step guide right inside TradingView. After that, and this is key, we'll learn how to actually read and understand the results. We'll also cover the common traps people fall into, and finally, how you can confidently take a strategy from a successful test into the live market. All right, first things first. What exactly are we talking about when we say backtesting? At its core, this whole process is about one thing: moving from pure guesswork to having a strategy that's actually backed by data. And I want you to really stop and think about this. That strategy you're running right now, or the one you've been thinking about trying, what hard evidence do you have that it actually works? If the answer is, not much, don't worry, you are in exactly the right place. So this is the textbook definition, but think of it like this. Backtesting is basically your own personal trading time machine. It lets you take a very specific set of rules, your entries, your exits, your stop losses, and run them against months or even years of historical price action. The goal isn't to find some holy grail, but to understand your strategy's true personality. You'll see its strengths, its weaknesses, and most importantly, how much risk it really carries. Okay, enough theory, let's get practical. We're now jumping into the real how-to part of this, the exact steps you need to take inside of TradingView to get this done. And really, it all boils down to these 4 key steps. Number 1, we have to define our rules on paper. Number 2, we've got to get those rules into TradingView with a script. 3, and this is a big one, we have to configure the settings to be realistic. And finally, step 4 is to run the test and know how to find your way around the results. And I can't stress this enough, do this before you even open the TradingView app. A vague idea like buy when the RSI is low is going to give you a completely useless backtest. You have to write it down. What exactly triggers an entry? What tells you to get out? Where is your stop loss placed every single time? How much are you risking per trade? Be incredibly specific here, because the quality of your results later depends entirely on the clarity of your rules now. All right, you've got your rules written down. Now you need a way to tell TradingView about them. You've basically got 2 main paths here. If you're a coder, you can jump into the Pine editor and write or paste in your code. Just make sure the script uses the strategy function, not the indicator function. But if you don't code, no sweat. There are amazing no-code tools like Pineify that let you just describe your rules in plain English or use a visual builder, and it will generate the Pine script for you. Okay, now listen up, because this is the step that separates a meaningful, realistic backtest from a worthless fantasy. So many traders just add a script, see a huge profit number, and get all excited, completely forgetting to factor in real-world trading costs. Please, do not make that mistake. So, in the strategy tester settings, it's that little gear icon. You have to get this right. First, set your initial capital to an amount you would actually trade with. Then, and this is absolutely critical, enter your broker's real commission rate. I've seen strategies that look amazing turn into losers once you factor in fees. Also, add at least a tick or 2 of slippage. This mimics the small price difference you almost always get in live trading. And finally, define your order size. The bottom line is, make your test as close to reality as possible. So once you click Add to Chart, this strategy tester panel will pop up from the bottom of your screen. The Overview tab is kind of like your main dashboard. Performance Summary is cool because it shows you if your strategy works better going long or short. List of Trades is the raw data, every single trade, logged. And always take a quick peek at the Properties tab just to confirm that your commission and slippage settings were actually applied. As you're looking over your results, just keep this number in your head. For a backtest to be statistically meaningful, you need a decent sample size. A handful of trades could just be luck. The absolute minimum is maybe 30, but professionals aim for at least 100 trades. More data simply leads to more reliable conclusions. You know, running the test is actually the easy part. The real skill comes in the analysis. Now we've got to figure out how to look at all this data and decide if a strategy is actually worth pursuing. I know, it's tempting. Everyone's eyes just zap straight to that net profit number. But honestly, it's one of the least important metrics on its own. A strategy with a huge profit could be hiding absolutely massive account-destroying risks. We have to dig deeper than that. So the first metric you should really be looking at is the profit factor. A good starting point for a healthy strategy is a number greater than 1.5. If it's below 1, well, the strategy is losing money, plain and simple. The idea here is actually really simple, but so powerful. A profit factor of, say, 1.8 means that for every single dollar your strategy lost, it made back $1.80. It's a pure measure of your strategy's profitability engine. Anything above 2.0 is considered really strong. All right, the next absolutely critical metric is maximum drawdown. This one is all about risk. A common goal for a lot of traders is to keep this number under 20%. And this is where the numbers on the screen meet human emotion. Drawdown isn't just a percentage, it's that gut-wrenching feeling of watching your account shrink. It's the biggest single drop from a high point. So, if your backtest shows a 35% drawdown, you have to ask yourself honestly, could I really stick to the plan while my account is down by more than a third? This number tells you how much psychological pain the strategy is going to put you through. Now, to get the complete story, you'll also want to look at these. Compare your strategy's profit against just buying and holding the asset. Did you actually beat the market? Look at the win rate, but look at it with the average win-to-loss ratio. A low win rate is perfectly fine if your winners are huge compared to your losers. And the Sharpe ratio is a great one. It tells you how good your returns were for the amount of risk you took on. Okay, you know how to run a test and how to read the results. Now, let's talk about the traps. These are the common mistakes that can make all your hard work totally meaningless. Think of these as the pro tips that will save you a ton of frustration and money. These are basically the 5 horsemen of bad backtesting. First is overfitting. That's when you tweak your settings over and over until they're perfect for the past data, which means they'll almost certainly fail in the future. We've already hammered on ignoring costs, so don't do that. Repainting indicators are sneaky. They use future data to plot their past values, making them look impossibly good. And finally, make sure you test over all kinds of market conditions. Bull markets, bear markets, and boring sideways markets, not just the last 6 months of a crypto bull run. So how do we pull this all together? Let's build out a clear, simple action plan that can take you from just an idea in your head all the way to a live, running strategy. This is it. This is your checklist. This is the whole process from start to finish. 1. Write your rules down. 2. Build or generate the script. 3. Configure realistic settings. 4. Analyze the deep metrics, not just the profit. 5. Run it on a different set of data to validate it. 6. If it still looks good, paper trade it forward for at least a month or 2. And only if all of that lines up do you go to step 7, deploy with real money and execute with discipline. You now have the complete framework to turn your trading ideas from hopeful guesses into strategies that are actually backed by data. You have the steps, you know the metrics to watch, and you know the traps to avoid. So really, the only question left is, what's the first strategy you are going to put to the test?